Hello legends, it's Guan here. Good to see all of you here today. Thanks for tuning in for today's video. Alright, we have literally got over 40,000 publicly listed companies around the world for us to invest. But does it really mean that we should buy all of them? Of course no, you'd be bankrupt if you did so. In this video, I'll cover the 6 types of stocks that we all should probably avoid for the better of our sanity. Let's get right in. High debt company. Let's start off with the list with this one, high debt company. Well, Evergrande, the Chinese property developer, definitely fits this criteria. I've previously made a video about Evergrande debt crisis. Click the link in the description or the bubble on top to watch it if you want. Here's a simple analogy. If you're a lady, would you choose guy A with tons of credit card debt versus guy B with little to no debt to be your husband? Guy A had already racked up so much debt and has difficulty in paying off interest. Do you think guy A would be a good choice?
Loser! You're a loser!
So ladies, save your sanity. Choose a guy who can manage his finances and his life. Save yourself from the trouble. Likewise, choose a well-managed company. Basically a company with little to no debt and is able to pay off loan interest with no problem. A quick tip here would be to look at the total debt to equity ratio of a company. The formula basically is total short-term debt plus total long-term debt divided by shareholders' equity. If this ratio is above 1, it means that the company has more than $1 of debt for every $1 of shareholder equity. Take note that you should always look at this ratio in a 5-year trend or compare it against industrial peers for better context. In fact, China's Evergrande always had an average debt to equity ratio of higher than 6, meaning that Evergrande had more than $6 worth of debt for every $1 of shareholder equity. As a result, they are now struggling to pay for this loan interest. If they fail to pay for this loan interest, it technically means that the company will become insolvent. To sum it up, it's bad news waiting to be exploded. Another tip here is that to look at the interest coverage ratio. The formula basically is earnings before interest taxes divided by total interest expense. If this interest coverage ratio is 10, it means that there are $10 worth of earnings before interest taxes for every $1 of interest payment. Basically, the higher the interest coverage ratio, the better. Before we go, be sure to like, sub, click the bell for more video every Friday. Alright, into the next segment. High Dividend Yield Company. Let's take a look at Astro Holdings, a Malaysian TV broadcasting company. Possibly the company that every Malaysian hates passionately.
The world champion.
Astro's current dividend yield is at 8%. This is at least 2x above the typical 4% dividend yield. For context, dividend yield equals to dividend per share divided by price per share. Now you might think that 8% dividend yield is damn nice, right? It means that you can get back your money in 12.5 years and just sit and wait for the money to come in automatically.
Wow, so nice one ah. Then just buy.
Hold up. First of all, Astro's revenue had been on a declining trend in the past 5 years. The same goes to the dividend trend in the past 5 years. Take a look at its share price for the past 5 years. This is basically like a share price just vomited everything. Their dividend payments did not increase. Surely it's a share price that has been dropping that made the dividend yield look good on surface. Decreasing revenue as a result of decreasing number of subscriptions, and this shows that there are good reasons why the share price didn't go to the moon. Another big red flag is the high dividend payout ratio. Dividend payout ratio is equal to total dividend divided by net income. You will notice that Astro has had over 100% dividend payout ratio in the previous years. This shows that Astro hadn't been prudent about the capital allocation when their core business was being challenged by Netflix, YouTube, Disney+, and more. Think about it for a second. When a burger store's business is going down the hill and yet is still forced to pay dividends to shareholders, then burger store will for sure go bankrupt. You need to know that high dividend payout companies often means that the companies don't know how to allocate the capital or don't have avenues to grow anymore, hence the high dividend payout ratio. However, do note there are also great tech companies with excellent R&D growth that give dividends like Apple, Tencent, Microsoft, ASML, and more. So the context here is really to focus on companies that know how to better allocate capital for good use. Alright, to the next segment. Companies with sketchy management. You definitely want to avoid companies with management that often promote their shares, saying something like,
"Hey, my company shares should be worth at least $100 billion market cap, man. You all should buy in now before the share price goes to the moon."
Company's management has a duty, and the duty is to operate and improve the company's operations. Share price shouldn't even be their mouthpiece topic. Anyway, a simpler analogy here. If you hire a maid to clean up your house, and the mate only talks the whole day without doing work, you wouldn't feel happy about it, will you? Best example is Elon Musk of Tesla, where he often talks about how Tesla has improved and the operation progress, as this gives a sense of transparency and accountability for his work. About this. So all in all, just avoid them when you see one. Save yourself from the trouble. Alright, to the next segment. Hype IPO companies. You see, IPO means initial public offering. Basically, it's a sale of companies' shares to the general public. And you notice a trend where 99% of the time the share price would skyrocket to the moon in a few hours of IPO opening. A simpler analogy is that, why so eager to buy the iPhone 13 when you know that the price will drop sooner or later?
It was at this moment that he knew. He f***ed up.
Oh, okay, I guess I'm wrong. I really underestimated people's desire to own an iPhone. Sorry, Steve. The point is, if a stock is good, it does not mean that you should overpay for it. Likewise, would you pay $5,000 for an iPhone 13? Probably not, unless you're some rich Saudi prince. Another myth is that if a company goes public, it must be financially stable. This couldn't be further from the truth. Take a look at Luckin Coffee, Enron, Wirecard, and others. These companies were godlike at the moment they listed, but turned out to be a total fraud. And not just that, according to Dimensional Fund Advisors, which is an investment fund advisor, a hypothetical portfolio of IPO stocks would underperform the major market indices in the 1992 to 2018 period. So now you see, this is the true cause of buying into the hype. Alright, into the next segment. Moatless companies. If you are given a choice between investing in burger store A and burger store B, and burger store A has great management and increasing burger sales, whereas burger store B does not have great management and decreasing burger sales, which burger store would you choose? No-brainer question, right? Of course, burger store A. In this example, burger store B is the moatless company here. Likewise, in investing in stocks, we need to constantly look for companies that have a leading edge in the industry they are in. Moatless companies will appear super duper cheap on any valuation metric, but in reality, the core of the business has been corrupted so badly and a cheap valuation does not justify the value anymore. So, not all cheap things are good, you know? Best example would be IBM. IBM was once the most valuable tech company in the world, but started to lose its lead in both PC hardware and software as competitors like Apple and Dell kicked IBM out of the scene. IBM did not react to the innovation of Apple and Dell, and therefore the share price peaked in 2012 and had been trending downwards. The share price did not go to the moon. Alright, to the next segment. Meme stocks. Okay, I know investing in meme stocks can be so tempting, especially from the AMC and GME insane stock price gains. And you think to yourself, if only I bought the stocks, I could have hot big. Well, in life, there's bound to be opportunity costs. You can't possibly make profits from every single investment. That's just how it works. It's worse off when you invest into meme stocks with leverage and lost all the money, just like Michael who had lost $42,000 in the GME and AMC stock trading saga. You would have to play Squid Game at some point to recover your losses. The question is, would you really want to play Squid Game? A simpler analogy would be, you go outside and play football or any other sports, and you know that it's impossible to score every single time, unless you're C. Ronaldo or Messi lah. There will be times where you score like a champion and everyone likes and cheers for you, but there will be times where you will get booed by people for not scoring like a champion. Such is life. And second point, we all don't have a crystal ball that can tell us the share prices accurately. If there was a crystal ball company, this crystal ball company would be the most valuable business, more valuable than Apple already. So if all these 6 types of stocks that are not really good for investors, how can we as investors pick a good stock then? Alright, into the next segment. How to find good stock. First, it must be a stock with a business model that you are familiar with, to a point where you can already judge within the first 5 minutes. If it takes a long time for you to figure out a business model, it probably isn't your cup of tea. Second, the management should have skin in the game, where they have a substantial amount of ownership in the company. Now this criteria might be a little bit hard, as some companies can still do well even with the hiring of professional CEOs whose compensation is often skewed towards cash rather than share compensation. For example, McDonald's business. The top 10 owners of McDonald's are all big name funds, no huge insider ownership. And yet, McDonald's revenue and free cash flow have been growing steadily over the past few years. There are always exceptions to the rules. Third, it should operate in a growing industry. For example, big data, energy sustainability, fintech, and more. After all, why would you want to invest in the Nokia today when the fact that no one uses Nokia phones these days? Fourth, you guessed it, little to no debt. Unless there are good reasons to have the debt in the balance sheet. Having debt is not necessarily a bad thing, but definitely a bad thing when a company's business model is inherently reliant on it and does not have a means to generate meaningful free cash flow. Fifth, a company that can generate consistent cash flow. More importantly, free cash flow. Free cash flow is like the oxygen of the company. Humans can't live without oxygen. The same goes to companies too. Sixth, a company that has the innovation DNA. For example, Costco is the leader at cost control, and Chipotle, where they just focus on improving the Mexican cuisine, and is therefore reflected in their share price. You can see the share prices literally went to the moon. Alright? To the final segment. My final thoughts. All in all, it's really a rinse and repeat process of researching and valuing companies. You can't possibly get all investments as multi-bagger investments, but knowing what kind of stocks to avoid would have scored 50% for your portfolio already. By the time you invested in the good companies, your portfolio will reflect the results and you can be happy like this cat vibing. So type yes in the comment if you have learned something new. Feel free to comment on what you have learned. Be sure to like, sub, click the bell for more video every Friday. That's it, legends. Thanks for watching. I'll see you in the next one.